Good day. Welcome to Financial Markets and Equity, Part 2 for Finance 311. What I'm going to do today is I'm sort of going to go back and rehash some of the things I previously talked about. Now, my point of view this week is on the equity markets as a whole and looking at it from either a trading perspective or an investment perspective. I just want to come back to applying this to your personal life. There's a difference between saving and investing. They're not the same thing. Saving is the act of putting money aside from your income for the future. That's step one. Investing is what you do with the savings. So I want to make that real clear, and I sort of probably have overemphasized that. The other thing I'm going to overemphasize is the difference between trading and investing. They are not the same thing. And when we look at it from an analytical perspective, what we're going to find is there is a difference in strategies that one applies. So trading is an activity performed in a short period of time to profit from market fluctuations. It can be from seconds to months. The strategies can be very different than what we might use for investing, which takes a longer-term view on a portfolio or collection of assets with the longer-term goals of capital appreciation and income. So on trading, you're looking to make a quick profit versus investing, which is a long-term strategy. So how you take that into account can be different. Now, one of the things we have is we have asset classes. And within asset classes, that's a trade-off between risk and reward. Just to put it simple, it's just a different mix of investments that have different characteristics. So we have stocks or equities, bonds or fixed income, treasury bills, which if you remember from previous lecture, are obligations of the U.S. government. We have cash in banks, CDs, and then we have alternative investments. Alternative investments include gold, silver, oil, corn, pork bellies, real estate, foreign exchange. Each one of these has a different, unique risk and reward profile. Now, what I want to show you here, and this becomes sort of a key thing, is what has performed over a longer period of time. And if we go back to 1925, right here, and you start out with a dollar, how much is it worth today? So when we start out with green is treasury bills. That's what the U.S. government is paying on 90-day treasury bills. That dollar that you invested in 1925 would be worth $21 today. Inflation, which would have been 1, would have made it worth 14. So just simply staying in treasury bills, you would have stayed in above inflation, okay, barely. But take a look at the next one, which are government bonds. These are longer terms, so this is 2 years and up. That would be worth 143. But you can see that there is a gap here. Okay, it's a little more volatility. It pulled away back in the 70s, but if you look at this over time, bonds produce more than treasury bills, more than inflation. But take a look at equities, and this brings it down, and I was going to use another chart, but I like this one because if you look at it, large stocks, those are the big ones, you'd have 7,353. If you had invested in small stocks, small cap stocks, it'd be worth 36,000. So now these are some pretty big differences. So over time, stocks clearly outperform other asset classes. But if you notice, these lines are more jagged, okay? And there's ups and downs. When we saw this drop in this down here, we didn't see much here. It was flat here, flat here. So with equities, we have more variation. But when we look at it over a period of time, stocks, especially small stocks, consistently outperform the market. Equities, besides breaking them down into asset class, equities can be broken down further based on U.S. companies versus foreign, because different countries have different growth rates and they're at different points in the economic cycle and development of the country cycle. For example, China, the middle class is emerging, where here in the U.S., the middle class has been here for quite some time. So there's a different cycle of demand. We then look at size of companies, market cap, which is the stock price, times the number of shares outstanding. You have large companies, medium, and small. And these are rough numbers. It's over $5 billion of market cap. It's big. Medium, 1 to 5. Small, less than 1. There's other measurements, but the concept is you're dealing with really big companies, which probably have an international exposure. Medium companies, which have some international exposure, meaning their sales come from abroad. And small, and most small companies, for the most part, don't have a lot of sales outside the U.S. When we look at asset class returns, I thought this was, again, very interesting. Look at the chart, not from what it says, but each of the asset classes is listed here, and you can read this here. But as you can see, purple was on the top 3 4 times, but it was also on the bottom 4 times. So you never know what area is going to do well. There's none that consistently is on the top, consistently on the bottom. So different asset classes have different returns. Why does that become important? Is that when you're trying to manage a portfolio, that you have this mix so that your portfolio has less volatility or movement. We break them down further by sector: basic materials, consumer, financial, real estate. We call them cyclicals. Defensive, these are the ones we sort of got to have. Consumer defensives are like Procter & Gamble, where you need toilet paper, you need toothpaste, healthcare, utilities. We all need to keep our lights on. So these are more defensive. They're not going to be huge growing companies, but they're going to be very straightforward and tend to be more consistent over time with less variation. Then there's sensitive: communication, energy, industrials, technology. So we look at it that way. Now, again, when we look at it, the same chart, we see the same thing. That with the different sectors, industries, you can see them right down here. And as we can see that over time, they've had, somebody's been in the top different times. But again, look at the best to the worst. So you'll find some that are, there's nobody, again, that's consistently on top, consistently on the bottom. So what we're looking at, this is just to demonstrate and to prove that when one is investing, long-term perspective, that we want this mix because we don't know what's going to come out once. So if we want to try to have a more consistent return with less volatility, we need what we would call a diverse portfolio. It's broken down by industries, and the variation is caused by different expectations for each sector. What's going on in the economy is going to drive that price. One of the things you're constantly going to hear in the investment industry is past performance is not a guarantee of future results. Future results or past results are not indicative of future results. They may lose value. So there's always that disclosure there, because there's no such thing as a sure bet. There just isn't. When we look at equities, stocks have risk. They can move up or down. The price of the stock is essentially driven based on the expected return of the firm. What are the earnings? So now everybody here, you've gone through what the historical return has been. So a stock price reflects on that. The market looks at that and says, this is what they've done. And then we start to make this transition to what does the future look like? Once you understand the past and how they have implemented strategies, you can move forward to be able to estimate the returns. Now, returns and price of stock are driven by macro events. Okay, so today we got tariffs are coming into play. Okay, well that may have that, an oil supply or shortage. That will affect things on a macro basis. Geopolitical events, hurricanes, storms, something that's not within the control of the firm. Then you have those things that are actions of the firm, whether that be a management process, be products, be process innovation, is some of those which are the strategies that you may see in your 10K investor presentation, your Part 3 application project, these can drive price too. And these are constantly monitored by analysts, investors, traders, trying to find that competitive edge. Who's going to be the next Facebook? Are there two women in a garage developing something that will replace Facebook? Value is driven by cash flow in everything we do. So some of it is our point of view. Short term versus long term. It seems that corporate America today is focused on quarterly results. What are they doing for the quarter? And the equity markets lately have seemed to focus on short-term results. Okay, and that's sort of an interesting piece. I've attached an article in Canvas for you to look at on this point of